What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is September 8th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we've got a wide range of topics to focus on. We're going to start off by taking a look at cryptocurrency markets, talking about that billion-dollar Bitcoin transaction that happened back 2 days ago, and seeing what we have to work with to understand what it was about. And then outside of that as well, in the sense of traditional markets, talking about the phenomena of stock buybacks, something we've discussed for a long time, and how to spot when the stock buybacks are going to falter and potentially lead towards a clear sign that equity markets are ready for a pullback. All right, we've got a lot of things to discuss, guys. Let's go ahead and dive right into it. As we take a look here at the market, we can see Bitcoin is really in a no trend scenario. It's between 1 to 2% to the upside or downside, really down here at 0.36%. So still up over the last 24 hours, but nothing significant. However, we got to take a look at the broader market right now, guys, because we're seeing a lot of recovery here, really from the last 2-3 days of sell-side action in altcoins. We've finally actually seen a very quick resurgent recovery in some of these plays. Energy, for example, being one of the more kind of oversold plays in our top 10, coming back 17% here. And if we take a look across the list, guys, again, broader market here doing quite nicely with a few exceptions down here at the bottom. So really good to see here. Glad to see that the overall market is seeing some buy-side activity, some decent volume across the board. But let's go ahead and take a look at overall market capitalization. Not really changed, right? This is not something to freak out about, guys. It's not a trend shift. This isn't something that's getting me too excited. And even in dominance, right? We basically just closed down on the dominance gains that we've had really over the last, say, week or so, right? Really back here since September 2nd. So, it's just about 3 or 4 serious days of sell side action that was giving Bitcoin dominance, and then we've had the reversal over the last 2 days. So anyways, nothing too severe here. I want to see, again, as I've mentioned in the past, you guys want to know what I'm looking for an altcoin cycle. I have my periods of time where I'm looking for the highest likelihood of that, which would be when we revisit 20,000 for Bitcoin. However, one of the clearest signs for a trend shift here is a serious shift in dominance. And that would be within a day or two seeing 3 to 4% depletion of Bitcoin dominance, where Bitcoin might be pushing sideways, might be depleting a little bit, and altcoins really start to rally, double-digit territory style. That's what I'm looking for. Anyways, nonetheless, again, we've talked enough about altcoins. I want to focus a little bit on Bitcoin here. Now, in the sense of price, not much has changed, guys. I'm not going to overanalyze price. It's been pushing sideways in between some of our key moving averages, and almost kind of looks like it's waiting here for the 200 day to come up, interestingly enough. But besides that, I want to talk a little bit about how TA can be subjective. And some people have pointed this out in the comments. Some of you are active traders out there, and you like to do TA. And again, I would say that the comments are kind of disagreeing, I guess, with my point of view. And I don't really mind that. I like to hear different points of view. I think that's one of the healthiest things you can learn to adapt to, is hearing different perspectives. And I'm really comfortable to where sometimes, for example, I'll be talking with people, they give me an explanation for why they see something the way they do, and I'm like, oh crap, wow, that's actually really true. I didn't see it that way. So I think that's a very important thing. If you guys are ever going to be trading or trying to do TA, that's a skill you need to have. But I want to spend some time to talk about another perspective on the current wedge that I've been seeing in price. Some people were saying that if you draw a line here, for example, some people might have it a little bit different, but if you really draw a line across the board here, right, we got a flat line here from this candle here on, sorry, let me get my line tool here, from back here on June 18th, what we're really building is a descending triangle, right? So you got the lowering highs here and a general support range, right? And if you are someone like myself who actually does give some room for the wixes, for example, to cause a little bit of anomaly from finding an exact support there, yeah, of course, this could still be a descending triangle, absolutely. And I think it's important to have these different perspectives on TA. The one thing I will say, though, is that each of these times, bear in mind, where it made contact with this line, we're setting higher lows here. So for example, from the bottom wicks here, $9,049, right here, $9,111, and right here, over here, sorry, on this candle, we had 9,350, right? So each time we're setting a higher low in this case where buyers are coming in, right? This is when price rebounds, and again, you start to see the trend reversal here. Price starts going back up again. Now, again, what does have me concerned here is that we are finding more consistency at the support range than at the resistance. And this would actually lead towards a good argument for those who see this as a descending triangle. And either way, no matter if you see a potential for this as a descending triangle, be open to the idea, guys, that there is a potential for the bearish play. I've been saying that ever since I've been talking about the wedge. That's why I like wedges, is it's like, look, you know, I've averaged towards the low end range. If it breaks through to the bottom, I'm not going to fight it. If it breaks below the line of support severely, then yeah, the trend is probably going to shift. And I'm not going to try and buy it and stuff. I'm going to wait until we get to a point where there's a good buy entry, right? So I don't want to try to overanalyze it, or I'm not a perma bull in that case. I would love to see Bitcoin continue to rally, but at the same time, I'll be just as happy if it corrects and I can average out, for example, down a range here like 7,700, or maybe it comes back down here somewhere in this range, like 8,000 to what we've seen before, or maybe even what I think some very large bears would believe is going to happen, and that's coming back down to 6,000 here, and maybe making contact on a moving average, like for example the I think it's the 50 week here. Sorry, let's mix them up. Usually don't see the 100 week above there, but in this phase of the cycle, I guess that's pretty common. But anyways, coming down to something like that, you know, making that support again. I really don't know if I see that with the macro environment that's going on. I can understand that if you're just in crypto, but if you see what's going on in the macro environment, and you got things like backed and everything coming, again, I have no doubt it could drop through here and drop to a lower level, but I don't know if I see it going down to like 6,000. We'll have to see though. Again, it really just depends here. If there's not enough buy side pressure, sure, but I don't know what in this case, I mean, with just how much resilience we've seen in crypto markets this year, it just doesn't seem like it fits the current trend. All right. So anyways, just my 2 cents. Again, overall broad market here, starting to look like it's doing well, either catching up to Bitcoin over the last 7 days or outpacing Bitcoin in the case of plays like EOS. And I think we had a few other ones. Bitcoin Cash holding up there as well. So yeah, again, most market players still behind Bitcoin here. We still got a little bit of ways to go before we start screaming altcoin cycle. So I want to quickly talk about this $1 billion whale transaction on Bitcoin. It's interesting enough that someone was saying that you know, they only paid $300 or $400, and I think someone was joking. It's like, oh my god, they overpaid for that. It's funny because they did pay a higher transaction fee, and that's the cool thing about Bitcoin. Well, it's kind of cool in a sense. You can pay a higher fee for transactions. Some people agree or disagree with it and stuff, but either way, you know, to prioritize these very large transactions, you want quick finality. You want to get in the next block, and I think they paid like much higher than what they would have needed to. You would have just had to pay like $10 or $5 or something, and you would have absolutely had a guaranteed spot in the next block. But they just didn't want there to be any extra competition, I'm assuming, that would outpace them. Anyways, long story short, we've been seeing over 94,505 Bitcoin moved to this single address. Now, it's not coming from one origin address, right? They all moved into a single address and then had transacted it over to this newer address, which made the $1 billion transaction. Before that, it was a lot of separate transactions, which we'll take a look at in just a moment. So this article kind of dives into it, but I just want to go to the direct tweet here from Token Analyst. So they actually broke down in these really interesting diagrams how the transactions actually flowed. And we have a much more simple chart here that I want to focus on just to kind of look at here. So this is the address where funds flew to at the end of it. This is where the UTXO was created, the unspent transaction output of 94.5K Bitcoin, or $1 billion in Bitcoin was sent over to this address from this transaction, right? And where each of these UTXOs is worth over 120 million, okay? So you have all this money transacting here into this one address over here. And this is a third of the Bitcoin, right? A third of the Bitcoin, bear in mind, was sent from Huobi, or from Huobi. Mispronounced that. We recently had Huobi on as a sponsor, but from Huobi. So very interesting kind of correlation here. The fact that a third of it was sent from Huobi. Why is that? Is it that this just happens to be where the Bitcoin that needs to be sent over, happens to be from Huobi? Could it be that, there's a lot of outflows from exchanges going into something like Backed? Could this be an address for the Backed custodial? Right when, on the 6th, when this transaction happened, that's when they opened up their warehouse to start storing Bitcoin for the physically settled futures. Who knows? We still don't know exactly what happens. This is the interesting kind of like phenomena with Bitcoin. We have all of the transaction history here. But unless we're ledger analysis, or unless we, can look at who owns these wallets, whose accounts these wallet addresses are tied to under these exchanges, we can't really get an idea of that. And it's probably for the better. I believe in the privacy in this case. I don't believe we should be able to know exactly who's shifting their money where and stuff, right? That's not probably our business, but it is interesting in this case to see these large transactions. And it's a big proof that there's a lot of value in the Bitcoin network when you can transact such large sums of value and know that you can do it securely, which is really interesting. All right, so I want to talk a little bit. I'm not going to take so much time to take a look over equity markets, but I want to talk about one of the biggest things, and we've discussed it far back. I mean, as far back, I'd say probably, actually, it was, I guess we really started talking about it in September and October over here of 2018, of the thing that has propped up stock markets to no avail, and that is stock buybacks. We even called back here in early September that there was going to be a major correction coming to markets. And that was due to the fact that we were going into a buyback blackout period, right? And that's basically when there's a short period of time due to a certain rule. I think it was by the SEC. Well, it's under SEC ruling, but basically where companies are actually not allowed to purchase their own shares. Okay, so it's a period of time where due to the date of where you release your earnings report, a company cannot go about actually buying any more of its shares. And there's a certain peak period of time where around 85% of companies usually can't buy back their own shares. And it led to this sell-off. It was a huge component to this sell-off that led into the sell-off back here into December of 2018. A very quick sell-off for the market. But this worry has only grown bigger because stock buybacks have been the biggest buyer in the overall equity market. Warren Buffett? Not Warren Buffett. Maybe retail investors buying the top. Nope. They're actually still at a negative outflow since 2008. They've surely grown a little bit over time. But let's take a look at the data here. All right, from Deutsche Bank here, back in September, this is actually a print off here from the Daily Shot, which we also take a look at, Daily Shot Brief, September 6th of 2019. Both in dividends and buybacks, we have set to record high levels of stimulus. Even if you remove the dividends here, again, just comparing stock buybacks, we have outpaced what we did back in 2007, the absolute bubble that we were in back in 2006 and 2007. And this is just one of the tools they have used to prop up markets. It's probably the biggest, though. It's probably one of the biggest ones out there, at least in the top 2 or 3. And if you compound that in with dividends, dividends are a big incentive for people to just hold stocks, right? Because you're making a fixed return in this case. And if your dividends outpace treasuries or other types of investments of that sort, as long as they can keep providing the dividends, it's all good, right? Now, again, if we take a look here, if you really don't believe how much of an impact this has had on markets, take a look at the cumulative buying and selling depending on different types of investors. Institutions, still, since back here in 2009, massive outflows. Huge outflows. Take a look here at households. Wonky, sometimes entered into the positive range, mostly remained negative for some time, and we're still seeing an outflow since back here in 2009. Rest of the world, right? Rest of the world has gotten some exposure, but it is dwindling. It's been dwindling ever since back in 2015 when we started to see the first flash crash in August of 2015, which again led to a slowdown in emerging markets, which makes sense here, right? Emerging markets have been dry for liquidity. Non-financial corporations, large tech companies, major conglomerates like Procter & Gamble, Johnson & Johnson, huge pharmaceutical companies, all these big players, they're cash rich. They're not going out and building new factories, investing in new products. They're not revolutionizing their industries. They're simply doing what better interests their shareholders, aka themselves, because they own a lot of shares in their own companies. They're buying back shares. And what it's doing is it's providing a blanket, a massive blanket of support and buy-side pressure on the market that allows them to drop their bags, basically sell off at a record level their own shares, right? But the thing is, so long as corporate profits keep going the way that they are, this can keep going on. It's completely legal. There was I think a pullback in regulation. I think it was under the Reagan administration back in the 80s. Like I said, there's a lot of things I like about Reagan. There's a lot of things I like about presidents and other presidents. But I got to tell you, this is one of my, and I'm a libertarian at heart in most ways. I highly disagree with the flexibility that's provided for stock buybacks, because I got to tell you something, guys. If you think that the economy right now has been growing quite good since the repatriation of funds, the cut in corporate tax cuts, those are things that I was really happy to see, because you have to keep competitive. The problem I see is that there's not good incentives for that money to flow into real world investments. It has been it's a huge malincentive for any real investment, because when people own the shares of their own company as employees, or are buddies with the shareholders who have invested in their company, this provides them an easy way out at the peak of a market cycle. And the problem that this is going to lead to, who's going to be left holding the bag? Well, it's the companies. And the companies in this case, who have, again, borrowed corporate debt to buy a lot of these shares, have used their cash reserves, what they have to buy these shares, are going to be shocked. The employees are going to be hit and shocked, the ones who don't own a lot of equity, when all of those shares dwindle in value, when the Ponzi's over, when the bubble has imploded. And now the corporate balance sheets look terrible, because the guys, the big guys, the board of directors, the people who had the shares, they get to walk away with all that cash. It's as if we don't understand why there's such a wealth divergence in America and in the rest of the world. It's because of systems like this. It has nothing to do with, well, we're not taxing them enough. No, it has to do with where the money flows and how they get the money. That's all it is, right? So I'm sorry for ranting and raving, but again, I've got a lot of other things that I want. Again, I just want to zoom in on the chart here so you guys can see a good clear picture. I guess you can probably see it in the video. I guess it was silly me. I think you wouldn't be able to see it. But here on Yahoo, for example, this is an article back in August that one of the major analysts for JP Morgan, Marco Kolanovic, I hope I'm pronouncing his name right, he believed that stock buyback activity likely tripled during the market pullback. So what they're doing here is, again, I think it's using a compound of a mixture here of stock buybacks and dividends, where in any dip in the market, it's general philosophy that for those who are conducting the stock buybacks, who are the money managers for these companies' balance sheets, they're buying on these 5 to 10% dips across the board on the major indices. And again, continuing to either maintain or increase dividends to say, look, guys, it's best you not bet against the market. See, we're still setting slightly higher levels here, and with every dip, we keep going back up, right? Even though it's nothing crazy, right? We're still getting higher lows here and higher highs. Just keep adding in. Hold long term. Passive invest. Don't even worry about what you're investing in, because you can just buy an ETF and don't stress about it. Don't even know what you're holding. It's like that's the philosophy that's really propped up equity markets. Everyone knows it by now, but to be fair, it's working. It's been working for a very long time, and it will continue to work until it doesn't. When corporate profits start to falter, this domino tips over. So where can we go to know when this activity can't prolong like this? Well, we have to simply take a look at when there's a mixture of two things. A cut down in corporate profits, and then also a vulnerable period of time, and that is the blackout period. And I think it's going to be a combination of these two. We've already seen something like this before when corporate profits started to slow down here at the turn of 2018, right? And we also had the blackout period here, huge sell side action. If the plunge protection team didn't step in, if there wasn't the $84 billion in pension funds remanagement from fixed income markets, bonds and treasuries, into stocks, this would have probably been the start of the recession. So this is the exact thing we want to look for here. We've got a lot of other macro factors to keep in mind, but this is going to be a big one here. So if we take a look here, this is again Yardeni stuff. We also use this for the central bank balance sheets, as you guys probably are familiar with. I want to go ahead and get a specific chart here. It takes the annual, the 4-quarter sum here, right? So we've got a chart here where we can see each quarter how much is being paid out in dividends, and then also how much stock buybacks there are with a 4-quarter sum here. So this is taking the last 4 quarters here, right? So If we take a look here, sorry, it's averaging it out in this case. Well, what are we getting over the last 4? So the thing to take into mind here is that we're pushing very close, whereas back here, since really we've had the tax breaks and the economy, the repatriation of money as well into the United States, encouraging a lot of money to flow into U.S. equities. We've actually held quite above this line in a very safe manner, but now here in Q1, we're really pushing along the line here. Now we don't have Q2 data, which is really the most relevant price information. We do it for dividends. But dividends, again, still remaining very close to this and almost kind of flatlining here since back in the late quarter of 2018, right? So the moment we start to break below this line for a good consistent quarter or two, as we saw back here, and as we saw over here as well in 2007, this is the sign that markets are going to falter. I know, guys, it just seems, it's so simple, right? To know it, like, you know, we're literally just using all these mechanisms to prop up markets, but that's what it is, guys. It's inflows and outflows. I've said it here many times in the channel. You guys are probably tired of me saying it, and it's the truth. It's the truth. Sometimes the truth is tedious. It's sometimes very simple, and sometimes you have to remind yourself that's really what this is. It's just inflows and outflows. And the moment there's not enough inflows, and we start to see the pressure from all those institutions and households and the rest of the world continuing to dwindle, the corporations aren't enough to supply the buy side activity, you can expect a recession very, very soon. It's inflows and outflows. Alrighty, well, I've got my sayings. Previous resistance becomes new support. Previous support becomes new resistance. Inflows and outflows. I hope you guys enjoyed this video. It was good to revisit this topic because I think it's very relevant. We've got if the time frames are similar. Last time we had this buyback blackout period here in October. So I really wonder if we're going to have this percentage of S&P 500 companies, which was 85% as peak. I wonder if we're going to have this at the same time period here in October. I'm hoping that we can get some data on that. I'm still looking at the moment. I'll get it out to you guys as soon as possible. But until the next video, guys, I'd love to know what you all think about this. If you could drop a like, leave a comment down below as well. Tell me what you think about all this. Do you think that we could see a combination of dwindling corporate profits soon as the economy possibly slows? And then also, when we hit one of these blackout periods, could it be really one of the dominoes to start ticking off towards downward price action? Or do you think it's going to be Fed monetary policy? Do you think it's going to be the trade war? Maybe a combination of these things. I can tell you the combination, the cocktail of interesting macro topics that have been going on towards the fearful side really, I think, are going to propagate a pretty serious sell side move in the market. But we'll have to see. I'm patiently waiting. We'll have to see over time. Not going to rush it. Anyways, I hope you all are having a great weekend wherever you are, and I'll see you guys bright and early on Monday for a daily update. Take care, everyone. I'll talk to you soon.